So there is no way today that the US banking system can multiply the monetary base to its fullest extent. In fact, it's an absolutely absurd number.
Okay.
So if you do the math about what that monetary base would look like, it is an absolutely absurd number.
I agree, but I think that's where the absurd numbers for gold and other assets come from, right? Is putting an absurd number into a calculation.
Yeah, but it's still absurd.
Yeah.
In other words, if you're a rational investor, and some guy comes up with fancy arithmetic to come up with some absurdity, you as a rational man are not going to immediately put all your money in that concept.
Agreed. Okay, so let's move on. But
Albert, let's just do the arithmetic.
Okay.
You probably know better than I do, but what is the ratio between, what is the mandated or the regulated reserve fraction at the moment?
I actually don't know. It's not a straightforward calculation because it's tiered. So
yes.
Yeah, so it's very difficult to know at any given time, I think, unless you follow this stuff very closely.
Which I don't. But let's play again. In the old days, the rule of thumb was a 10 times ratio, right? So you could leverage the monetary base 10 times.
You can use that number. It's like I said, the ratio is different depending on, I think, where I guess the distribution of the money. So there are many factors that factor into the number, but that's fine, take 10.
Okay, I'm going to do two numbers to illustrate the point. Right now, what is the monetary base? I don't know.
You're asking me?
If you remember.
Oh, I'm sorry, I can't do this.
It's what is it? 3 trillion or 4 trillion? I think it was 3 last time I looked, but I think it's gone higher. I think it might be 4 trillion.
Okay,
right
I
now.
can throw it up there later for the viewers.
We can do this real quick. Fed balance sheet. Okay, so the Federal Reserve balance sheet should be, it's just over 4 trillion. Looks like it's 4.5.
That sounds right.
Okay. So if 4.5 trillion was the monetary base, and we can multiply it 10 times, then we can create $45 trillion in the US commercial banking system. That's how the math works, right?
Okay.
Right now, the US banking system has $12 trillion in it. Just under 13 trillion. It's actually closer to 13 trillion. So that means that we'll go from 13 trillion to 45 trillion, which is 250% increase. Obviously, the money would be the value of the dollar would be destroyed.
Yeah, I mean it's a grotesque it's a grotesque number, but wouldn't put it past them. Seriously.
Well, but it gets much more grotesque than that, because if you actually look at the practical.
Oops, looks like we've lost Paul. Hold on, I'm going to try to get him back. Just 1 second. Paul, are you there? Yes, are you back now? Nope. Yes? Yeah, we got him back. Okay. So go ahead. We're talking about that grotesque number. You're saying it's much worse than it even sounds.
It's much worse than that, because if you look at the regulations, then the practical implication of the Basel III Accord is that the banks actually only have about 1 to 3% reserve requirement. And like you said, it's a tiered process, and it depends on the nature of the accounts and the nature of the assets, and it's far more complicated than it was in the old days. But the practical ratio is only about 1 to 3%. So if you take that 4.5 trillion in the US balance sheet, that means you can create $450 trillion in the US banking system. We only have 13 trillion. So that's more than 10 times that you can expand the US money supply.
Yeah, no, and then if you look at other aspects of it, so for instance, you know, the risk-weighted assets and what they have to hold against those, it looks like in that scenario, a lot of that newly created money would actually go into sovereigns. And I think that's probably the plan anyway. They probably want it to go into sovereigns.
Well, but that game would not end happily. So that may be the path of destruction of fiat money, because fundamentally, I'm no different than any other gold bug. I believe that the fiat money will go to zero. All the fiat currencies are going to zero. It's just not happening as fast as some people thought it would, but they're all going to zero. So I'm not trying to make a case that the US dollar will not go to zero. I'm just trying to make a case it's not going to go to zero next year or even the year after that. And the reason I want to make the case, or the way that I want to make that case, is by illustrating the fact that based on these fractional calculations, we can expand the US money supply from 13 trillion, where it is today, to 450 trillion. But the mechanism by which we expand that money supply is by the public taking out loans. So do you think that the average American right now can go and borrow 10 times the amount of debt that he has?
They certainly have the spirit to do that, right?
But the banks don't have the spirit to lend. And that's the other side of the equation.
Okay, well, maybe not, you're talking about risk, but maybe if they were extended certain guarantees from the government, they would. I mean, the government, here's the thing. You said that it was easier to make certain calculations several decades ago. That's true. And that's when the government wasn't running the banking system. So in a lot of ways, the regulators are actually determining the flows of capital. Like I said, if you look at the way that assets are risk-weighted, it's steering banks away from certain markets and into others.
But that's what government regulation does. I mean,
absolutely.
That's the purpose of the regulation, is to try and manipulate the market's behavior.
Right. So I guess we should move on, but all I'm saying is that it's as hard to believe as it is that the money supply could actually grow that much. It's not an impossibility.
No, I would say that it is not just we have to be careful with double negatives. It is not an impossibility. In fact, it is the most likely outcome. It's just not the most likely outcome in a short time frame.
Okay. So let's move on to the fair value question, though, because I'm sure everyone is interested in this. What does your monitor tell you now? Your calculations. What do they tell you now about the fair value of gold?
Okay, so what I basically do on the fair value of gold is I look at the relative increase or the relative inflation rate of the US dollar, and I compare it to the relative inflation rate of gold, as I've described both. And right now, I would estimate that gold's value vis-a-vis the dollar is around $1,100 to $1,150 an ounce. So not very far from where it's trading.
Yeah, very close to where it is now.
Very close to where it's trading. Mm-hmm. Okay, but it's not it's a coincidence that it's close. The numbers are not close because it happens to be the market price. You know, if you go back to my website, you'll see that this chart goes back to 1970, and I've been actually updating it for 10 years, during which the price of gold reached much, much higher levels. And I predicted that that would be unsustainable. And the price of gold is now coming back down to what I believe are sustainable levels, and go lower.
Paul, is this the highest that your fair value calculation has ever yielded? This 11, okay.
Yes. Now, Albert, that's an excellent question. And let's, just as a general rule of thumb, the actual inflation rate of gold is somewhere between 1 and 1.5% a year. It used to be 1.5%, but gold mine production has been declining now for many years. And so that inflation rate is actually declining. It's probably closer to 1.2% at the moment, 1.2, 1.25%. But the US dollar inflation, as measured by the actual increase in US bank deposit accounts, is closer to 6%. And that's the number that I update weekly on my website. Not the value of gold, I do that once a year. But the money supply, I update basically every week. And that inflation rate right now is sitting at just over 5%. So that means if you subtract the 1% from the 5%, the value of gold is going up by about 4% a year at the moment. Now, in the past, US monetary inflation was higher. It used to be 7, 8%. Gold inflation was a little higher. It used to be about 1.5%, 2%. But the value of gold then was going up, call it by 5, 6% a year. Now it's going up by 4% a year. But every year it goes up because the rate of inflation in the US dollar is greater than the rate of inflation of the gold supply. Okay,
very interesting. Now, let me go back to something you just said. We'll move on to a discussion of inflation. You look at inflation proper, the economist's inflation, that is money supply growth. Most people are interested in price increases or losses in purchasing power. How does your, I forget what you said it was. Did you say it was 7% growth in the money supply right now?
No, right now it's closer to 5%.
Okay, so
in fact, yeah, go ahead.
Yeah, so basically your calculation doesn't jive at all with CPI, and I guess it's closer to John Williams, his version of the shadow stats. He's seeing like 4% now, something like that. Okay, CPI is what, less than half, less than 0.5%.
Correct. Now, there's a logical explanation for that. This is where we come to the difference between value and price. Price changes in the short term because of supply and demand. If there's a short-term supply of something, its price will go up. Its long-term value may not change.
Okay.
But the short-term price could
Paul,
rise.
I agree, but I would add that price changes for a lot of reasons beyond the supply and the demand. I mean the mining supply and, you know what I mean, the industrial consumption, depending on what you mean by supply and demand. Are you talking about the industrial consumption and the mining output, or are you talking about just economic supply and demand?
You can put them all in the same category. But let's look at why is it that the CPI is so different from the fundamental inflation rate. It's because if you have weak economic growth, which is what we have right now, you have weak demand for goods and services. And we have overcapacity in the world. And the reason we have overcapacity goes back to what the 90s and the first 10 years of the 21st century. We were creating massive capacity through infrastructure development, but that was capacity that was created top down. In China, it was created by mandate. In the US, it was created through monetary policy that, in my opinion, was very flawed. But we created massive excess capacity. Now we have weak demand and excess capacity, so prices are weak. So your CPI is much lower than your actual inflation rate because of the capacity and demand for the production of that capacity.
Paul, I want to talk a little bit about China, because that's something else you mentioned in one of your writings. We see, again, that your predictions were rather bang on. We had someone from the Chinese Bureau talking about China's growth being within a reasonable range. People have been suspicious of their numbers for quite some time, but they're talking about 7% a year. Even if that's correct, it's definitely down or downward trending. And one thing that you talked about was how China being sort of the mirror image of the U.S. in the sense that they're engaging in debt finance production as opposed to consumption, debt finance production in the absence of demand. So it looks like this is exactly what we're seeing now. And what do you think the consequence, how this is ultimately going to play out?
We're living the consequence of that. This whole idea of low CPI numbers and weak global economic growth has a lot to do with what happened in China. China was financing construction of just about everything that you can imagine: roads, railways, bridges, cities, factories, anything that you can imagine was being financed through debt, because in China a lot of that free market is quasi-free market. So it's, in many cases there were very, very close relationships between governments at all levels, right from the central government to the municipal governments and the provincial governments and the corporations that were doing all this construction. And that was for most part financed with debt. And when the debt blew up, and it started blowing up around 2005, 2006, they took a page out of the US handbook and they created what was essentially collateral debt obligations. And they took the debt off the balance sheets of the banks. And 10 years later, when those off-balance sheet items started to roll over, then they just created new regs and rolled them again. So we knew that that system couldn't sustain itself, because you cannot in any economy continue to build production capacity for production. Whether that's housing, bridges, railroads, doesn't matter. You cannot keep building capacity if there's no demand for the output of those. It must fail. And in China, it did fail. It's busy failing right now. That's what we're seeing happening in China. The whole stock market crash. And their banking system is in far worse shape than the US banking system ever. But while that was happening, China was effectively competing with manufacturing capacity in Europe, the United States, and Japan. So a lot of what we were producing in these countries ended up being produced in China. And in spite of that transfer of production, China still created overcapacity beyond that. Plus, we now had redundant capacity in Japan, Europe, and it's not just Japan, it's Japan, Korea, Vietnam, all those countries, and greater European countries and North America. So we have massive overcapacity everywhere in the world of just about anything you can imagine. So it's no surprise that there's weak pricing, because there's no reason just to go up.
It's certainly a gloomy outlook, Paul. We're out of time for this segment, so thank you very much for joining me, and I hope we can do it again. I have a lot of other items here I wanted to talk to you about. We're just out of time. So I want to thank you for coming on, and please come on again anytime.
It would be my pleasure, Albert, anytime.
Thank you. My guest has been Paul van Eeden. He's the president of Cranberry Capital. You can find him at paulvaneeden.com. I highly recommend you go there and read his articles. Just incredible forecasting from 2009 and earlier. So thank you very much for that. And don't forget to visit powerandmarket.com for insightful interviews with the world's leading experts in economics, finance, and investing, like Paul Eeden. Paul van Eeden. Coming up next, the publisher of the Morgan Report. And you can find him at silverinvestor.com, where he'll be joining me next.